Chapter 5: The Cost of Money. Learning Objectives. Explain what the cost of money means and describe factors that affect the cost of money or interest rates. Describe how interest rates are determined. Describe a yield curve and discuss how a yield curve might be used to determine future interest rates. Discuss how government actions and general business activity affect interest rates. Describe how changes in interest rate or returns affect the value of stocks and bonds. Cost of money. Interest rates represent the prices paid to borrow funds. Equity investors expect to receive dividends and capital gains. Factors that affect the cost of money include production opportunities, time preference for consumption, risk, and inflation. Determinants of market interest rate. The rate of return equals risk-free rate plus risk premium. The rate of return equals risk-free rate plus risk premium. Risk premium include default risk premium, liquidity premium, and market risk premium. Term structure of interest rates is a relation between yields and maturities of securities. It's a graph of the term structure of interest rate, also called a yield curve. Why do yield curves differ? Expectation theory says shapes of the yield curve depends on investors' expectations about future inflation rates. Liquidity preference theory says lenders prefer to make short-term loan, borrowers prefer long-term debt. Market segmentation theory says each borrower was a preferred maturity, and the slope of the yield curve depends on the supply of and the demand for funds in the long-term market relative to the short-term market. Key cost of money concepts. What is the cost of money and how it is determined? The interest rate that lenders charge borrowers is determined by the supply of funds and the demand for those funds. What factors affect interest rates? The rate of return that borrowers expect to earn on their investment. Savers' preference to spend income in the current period rather than delay consumption until some future period. The risks associated with investment or loans, and expected inflation. How are interest rates determined? The rate on a loan includes a minimum payment for delaying consumption until some future date and payment for the risk associated with the investment or loans. What is the yield curve and how might it be used to determine future interest rates? The yield curve is a snapshot of the relationship between short-term and long-term interest rate on a particular date. The relationships among the yield of bond with different terms to maturity are used to attempt to forecast the future interest rates. For example, an upward sloping yield curve might indicate that rates are expected to increase in the future, and vice versa.